Uncertainty. That is the word I've heard the most here at the spring meetings this week so far. And markets don't like uncertainty. And I've got an expert here with me. It's Margaret Franklin, former president and CEO of CFA Institute, chartered financial analyst. Uncertainty is not new, though, unfortunately. Iran's the latest example. But how do you begin to approach that and use professional judgment in these uncertain times?
So it's a question I get asked often. And Tony, I feel like we come here every year and there's something we're talking about that is about uncertainty.
I hope we're not the bad pennies,
but yeah. No, it's not us.
Yeah.
So if we look at sort of history, there are shock moments. That is accelerating. The magnitude and the frequency of them are faster and harder. So think back just to 2019. We've had COVID. We've had the Ukraine-Russian conflict. We've had the regional bank failures, and now we have this. That's all in the space of 5.5 years. There are a couple of things. One is we have more experience with it, and we have more visibility, or at least frameworks, that we know what kind of interventions can happen. And so that's the first thing. Think about really aggressive, unconventional monetary policy, which has come in to save again and again. So when you think about markets, they do price in uncertainty, and it's whether that uncertainty has a really long tail to it. So the more we get certainty, the more we're going to be able to build portfolios to meet client objectives. Uncertainty does create opportunities, though, and we can see that happen. There'll be repricing of certain things, and astute investment analysts and managers and portfolio managers will be taking advantage of that because, that's what we do. It's based on analysis, it's understanding what your objectives are, and then building those portfolios to withstand sudden shocks because you can't anticipate them necessarily, and then being able to take advantage of them or avoid certain things depending on what you're trying to achieve.
Help us understand. So there are a couple of competing headlines just in the last couple of days. We've got, first of all, the IMF saying we're going to downgrade our projections for global growth this year based on all that's happening. But then we're also seeing quarterly earnings come out and gangbuster numbers from big banks and big corporations in America. How do you square those two things?
So I think there are asynchronous things happening. First of all, if you think about what we're experiencing with Iran right now, I think Christine Lagarde just did a fantastic job of saying we're now unpicking the consequence of it. So we know that there's been damage and destruction to oil facilities, processing and refining facilities, and we're not going to flip a switch and that's going to come on. Really, if you think about fertilizers, which we know pass through the Strait of Hormuz, that's planting season right now. That's not going to show up in food shortage or scarcity for many months hence. So that'll get priced in over time. And remember, the earnings are retrospective, and the analysis that's going on right now with what this means with Iran is prospective. So that's the challenge of us, is to understand as a profession, really, what are the consequences, what are the details, how does that show up in financially material ways in portfolios? Will portfolios respond accordingly? And that's why you need those professionals.
Well, it's interesting you say that because we saw something similar with Ukraine when Russia invaded Ukraine, that it was several months later that we started to see deep consequences for food and for fertilizer. We also saw, though, Europe pivot on its energy sources because it had to, right? Cutting back on reliance on Russian gas and oil, moving toward alternative sources. Do you think something like that could happen here?
I do, and I think about the energy complex in particular as a really interesting one. If we thought about climate and sustainability, there was a reasonable amount of slogan over substance. So we probably pulled that pendulum too far in the way we described it to citizens and the way we thought about it in portfolios. And then Ukraine, Russia conflict happened, and you have to have fossil fuels in the complex. Right now you do, and that's just a fact. Say what you will, emerging markets and developing countries need a baseline of energy security that they can rely on, and that's not going to happen solely with renewables. So now you get to this moment where we have a real oil shock, where policy here in the US is not necessarily constructive for developing and advancing an energy alternatives complex. And you can see the pendulum's going to pull a little bit this way. This is always the way things go. Policy, markets, they can go too far. And so the real job is to figure out, where are we on that? What unintended consequences can happen, and how do we think about that within a portfolio?
So when you talk about that swing away from alternative energy, and by the way, swing away from conversations about sustainability to some extent, and climate, which, by the way, we're not hearing a lot of arguments. Today they just did a huge event about water scarcity that was really about investing and bankability and making the case for why this is critical infrastructure. It's not necessarily based on climate change.
I might beg to differ. I think what we see when we're talking to clients, investors, asset owners, asset managers, central banks, governments, is that around the world, everybody recognizes that the impact of climate is financially material from a physical and a transition perspective, and they're carrying on. We're not talking about it in the same way we might have 5 years ago. But when we talk about water scarcity in those investments, that's really about finding investment opportunities without calling it climate. Maybe we've gone from greenwashing to green hushing.
So you're saying we've changed the semantics, but people still understand the science.
They do, but I do think it's a maturing and evolving part. It's becoming incorporated more in an integrated fashion within portfolios and within analysis, because it is financially material, depending on the company you're looking at, right? But not all companies are impacted by it. I think here, particularly at the World Bank and IMF, I think they're very cognizant that what they're trying to do, the primary objective, is poverty eradication and improving the conditions within developing markets through the levers that they have. That's not a climate first agenda, but it's not a climate absent agenda.
Right. Let's talk about AI for a second. So
yeah.
I remember in one of our previous conversations, we talked about how social media was changing the game for investing, but now AI is here. And I'm just curious how it's already impacting the work of CFAs, positively and perhaps negatively.
So I think there's a couple of aspects to it. First of all, at CFA Institute, we're definitely very concerned about the ethical application of AI. So making sure that where AI is applied, it's interpretable, it's explainable, it's reliable, it's got good governance around it, and it's delivering what it's designed to deliver from portfolio outcomes. And AI is not accountable. I guess that's the one thing I'd say. Humans are accountable for the outcomes. AI is a tool. If we talked last year, and I think we might have, is that 2 years ago, subject matter experts were really concerned about their role and being AI'd out. I would say 18 months ago, we realized they are the human in the loop. They know the questions to ask, and they know how to evaluate the output. Now we're seeing actually a fundamentally different capability from AI. And that is the ability to ask more questions, process more data, think about risk and return in different ways. That's the positive of it. We can customize more around our clients. We can evaluate risk and return in very different ways, more robust ways. So that should improve the investment outcomes. I would say most firms are actually using it more around productivity, and we just haven't seen that broad return on investment from a workforce talent thing, which is what it is. It's a workforce talent matter. Mythos moment, I think, will give everybody cause for pause on AI having an impact that we actually quite can't can't grapple with from a security perspective. It looks like it's the first moment where AI can act in an interest against what we thought it was doing. So I think we know it's serious. We know it's not limited to what our industry is doing, but of course the financial system is at the backbone of so many things and critical for society, for the economy, and for security. So I think it has so much promise, and it has so much complexity to it, including employment disruption and the consequences to society. So I think I'm an optimist, and policy will be required. How that policy gets done, whether it's by brute force of conditions, which sometimes we've seen in the financial markets, a shock occurs and policy gets made in response to it, or whether it's proactive will remain to be seen.
So you bring up as a final question and a final thought, so employment and jobs, by the way, has been a huge theme here for the past couple of meetings, and certainly it's still very much on the agenda now. There's such deep concern about this growing delta between the number of available jobs in the global workforce and how many young people are aging into that workforce. Do you see that as a bigger financial risk, or is there some opportunity there, and what would it be?
I do think it is in this very short term, because companies are pausing hiring until they really understand how AI is going to impact it. But a couple of things. One is, we know the demographics are, developed world is definitely declining. So we know that labor is going to be important. We see humans in the loop absolutely as required. You have to have qualified professionals. We don't see any jurisdiction where everything will be handed over to AI. So I think companies are being very thoughtful about what the talent they require is and what the jobs are going to look like. I thought Ajay Banga did just a fantastic job yesterday of talking about the developing market is not just a recipient, but it's where growth and consumption can occur. Well, all of us can participate in building that out and investing in it. And when you think about what that does, it does create jobs, broadly speaking. So I think it's technology is happening so fast. I think would be naive not to expect some dislocations, and that gives us a lot of cause and reason at CFA Institute to say, what do investment professionals need? How do we make sure that they are equipped? How do we make sure that they are job ready for the jobs, not just for now, but for the future? And I think a lot of sectors are doing that.
Margaret Franklin, thanks so much for coming by. It's always great to see you.
Thanks, Tony.